The Bank of Israel has raised its benchmark rate by the largest amount in more than 2 decades, hiking by 75 basis points to 2%. With inflation hitting 5.4%, the highest level since 2008, it said it remains determined to force inflation back into the desired range of 1 to 3%. The governor there also saying that the bank expects rates to peak at 2.75% late next year. One more central bank decision is expected before the election of a new government in November. So let's talk more about this with Christian Wietoska. He is head of Samir Research at Deutsche Bank. He joins us live from London. And Christian, great to get you on this morning. Thanks for getting up early for us. As you heard there, the Bank of Israel surprising the biggest rate hike in 2 decades here. What do you think peak rates is going to look like in Israel when we have this really high inflationary outlook here and still very much running above the bank's own target? Morning.
Yeah, morning. Thanks for having me. Yeah, indeed. The central bank surprised us a bit to the upside yesterday by hiking 75 basis points instead of the 50 basis points widely expected by most economists. However, if we look into the details here, I think it shouldn't be seen as such a big surprise that the Bank of Israel decided to go for 75 basis points at this point in time. As you already mentioned earlier, inflation has surprised to the upside. Headline inflation came in much stronger than expected. Core inflation has been on the rise. And what is very important, overall inflationary pressures have been very broad-based. And some of the stickier components, particularly housing, has been on the rise of late and actually is at record high levels. So I think there are some reasons why on the inflation front, why the 75 basis points hike at this point in time was justified. In addition, the growth dynamics have been quite robust. Q2 growth was decent. The labor market is quite tight. In addition, the PMIs, in contrary to a lot of other countries, has shown quite strong signs. So overall, I think the underlying story is quite strong. The reason why most economists, and including us, were expecting 50 basis points at this point in time was just the strength of the currency. Keep in mind that the shekel was one of the strongest performing currencies in the second half of the year so far, but I would say mostly due to the strong performance of U.S. equities rather than a repricing in rates. But I think that was one of the reasons that most were expecting a more gradual approach. But I think it's now very clear that this central bank is very committed to bring inflation back down. And one thing is also clear in Israel, in contrary to a lot of other countries, Israel has less of an inflation problem structurally than a lot of the CE countries, for example, or other EM countries.
It's really interesting to also see Turkey continuing to surprise here, shocking markets with this 100 basis point cuts. Rates now at 13%, inflation above 80%. This is crisis with a capital C, is it not?
Yeah, we're coming from one of the countries that has the most, upfront or most credible approach in terms of inflation targeting. The Bank of Israel to Turkey, a country where we have, headline inflation at above 80 or close to 80%, PPI at well above 100%, and the central bank decided to cut rates last week by 100 basis points. One can argue, what does it matter if inflation is if rates are 13 or 14%, if inflation is that high? But I think it had some implications, because I think if we read the press statement, it was very clear what the central bank is trying to achieve. What we have seen is that loan growth has been slowing, that the credit impulse has been slowing in the last few months. If we look at the spread in loan growth and commercial loans versus official rates, it has widened quite significantly. And I think it is very clear that given slowing domestic demand, given a weaker growth outlook, the incentive was rather to bring loan growth lower and to support the economy. Whether that's successful or not is very difficult to say at this point in time. I think we are questioning, of course, this approach to a certain extent. Turkey has benefited over the summer months from record high tourism revenues, which definitely helped. We have also seen some inflows on the FX reserves, which came from Russia over the last few weeks, which is stabilizing the gross reserves. On the other hand, if we look at the current account developments over the next few months, particularly with the high energy bill. Secondly, also with the challenging high debt repayments between September and December. I think the next few months will be extremely challenging for Turkey, similar to a lot of other countries where inflation is very high. But one thing is very clear: the central bank in Turkey has no interest at this point in time to hike rates further, and will do everything else to rather than hiking rates to bring inflation back down, which is very difficult. And if we look at our forecast, we see inflation at around 70% by the end of the year still, and only slowly coming back down. So the target will not be reached anytime soon.
Christian, I know you're not an oil analyst, but as someone who follows the oil markets for a gauge on the outlook for Gulf economies, what's your reaction to the Saudi Energy Minister's latest commentary talking about how oil markets aren't necessarily matching point on fundamentals right now, and OPEC could potentially be on track to cut output in order to mitigate the fall that we've seen in prices over the past few weeks? Your view, reaction?
Yeah, indeed. I think the oil market had some obviously supply constraints on the one hand side due to the situation in Ukraine, the war, the attack from Russia on Ukraine. We have seen the spike in the oil price now at levels, and we came down with a decline or the concerns about about global demand, and oil prices have come down from the peaks, and we're trading around 90, slightly above that. So I think it is clear that there is the communication at this point in time trying to stabilize the oil price and not letting it fall well below 90 at this point in time. Yeah, there is a lot of uncertainty in the market at the moment. What happens? How quickly is the Fed going to hike rates? How much is the impact on the U.S. economy? How quickly is Asia coming back in terms of opening up? And how quickly is China growing? All this uncertainty obviously had an impact on the energy market as well, and commodities have to a certain extent reflected this uncertainty. Our view is that in the medium term, in particular, one important factor around easing supply chains will help to bring inflation back down, to improve the overall global outlook, growth outlook, which would then stabilize energy prices as well. But it's very clear that there has been now, in a certain way, a clear signal from Saudi in the sense that they will not let the oil price at this point in time fall too much, and this should be seen to a certain extent also as a warning signal in how much we can benefit from lower oil prices in terms of our inflation forecast.